Hi guys, good afternoon all of you. I wish you a very happy May Day. May 1st is considered to be the day dedicated for laborer. And who's a bigger laborer than CA student? Tell me. So one side we study like slaves, one side we work like slaves in article shape. Okay, so happy May Day to all of you. So today guys, we are going to deal with RTP for May 2022. We are looking at advanced accounting, and it is very important before you write the exam, at least you do 3 RTPs. Okay, I'll try to help you with 1 RTP, and at least all the important areas of the RTP will be covering in this series of sessions. So this is going to be the first session in this RTP of advanced accounting May 22. Then they have given, so this is the document. I'm sure you know the path. You need to go to ICA board of studies, in that students in that board of studies, in that some students do not even know what the hell this RTP is. Okay, so you need to go to students and then board of studies knowledge portal. In that intermediate course, in that your paper, whatever you want, paper 1 to 8. So I went to paper, I entered inside paper 5 in that RTP. So in this is May 22 Hindi medium. We do not want that. May 22, this is the one. November 21, May 21. These 3 you need to do. You understand? And in that we are seeing the latest RTP. So the previous RTP anyway I have done, and in YouTube you can see that. Now we are doing the latest RTP. In this first A, applicable for May 22 examinations, whatever the changes are there, whatever the amendments are there, they have given it here. Okay. Then ESOP, about ESOP, they have given something. September 2021 edition of study material is to be referred. Probably you might be referring that only. Even in my classes, I refer many a times the soft copy from ICA website. So obviously we are using the latest study material. No problem in that. And then they said Ind AS is outside the scope of examinations. Obviously, Ind AS CA intermediate students cannot deal with also, because it is huge. Volume is huge, and also little more depth, complex, and logics are more. So obviously in CA intermediate level, you do not have Ind AS in your syllabus. That is what they said. Okay. And then questions and answers. Question number 1 is partnership. 2 is LLP. That is, I think, theory only. Sale of partnership they have given. Accounting for ESOP. So shall we start with ESOP? So who's there in the meeting? Sandeep is there. Hi, Sandeep.
Hi, sir.
Sandeep, how are you?
I'm good, sir. How are you?
Superb. I am also good, Sandeep. Tell me one thing. You have completed ESOP?
Yes, sir.
Very good. So we discussed that in the class?
Yeah.
Yeah. Do you remember what is vesting, what is grant date, what is exercise price?
Grant date is the date on which employee stock option is given to the employees.
Excellent. Very good. So this is basically the date of contract. So if you consider employee stock option scheme as a contract between the management of the company and the employees, the company and employees have entered into a contract wherein the company is saying that, dear employee, you have this option subject to XYZ conditions. So the terms and conditions and all, they will document, no? So that is the grant date. But very important thing is, it will not affect your problems, but theoretically, or even in practice point of view also, very important thing is, sometimes board of directors framed some ESOP scheme, they communicated that to employees are happy, they accepted. So management and employees, both of them, they accepted the terms and conditions, but still sometimes based on legal or regulatory requirements, the company needs to get it approved from the shareholders. So the grant date will not be the date when the scheme is prepared or communicated to employees. Grant date is the date when the shareholders passed a resolution. You understand it? Hey, Sandeep, you understand it, ma?
Yes, sir. Yes.
Yes, very good. So now What is the second one? First one is vesting. What is vesting?
Is it the exercising of that right?
No, vesting means, see, majority of the cases, ESOPs will be given subject to some conditions. For example, time-based condition. You need to work for 3 years in my company. Correct? Right? Respond.
Yes, sir. Yes, sir. Yes.
What can be other condition? One condition is time-based condition, service condition we call. Other condition is
So performance related.
condition. Second one is performance condition. Performance condition means individually, maybe you should be able to achieve so-and-so target, or collectively the company's return on investment must be 15%. Net profit should be 5 crores. EPS should be so-and-so. Or the market price of the share can be so-and-so. So it can be based on the internal performance, or it can be based on stock market performance of the company's share. So the day when the condition is satisfied, that day we say that the options have vested. So vesting means technically complying with the condition. You satisfied the condition and you are eligible as an employee who satisfied the condition. You are eligible for 100 options. That is called vesting.
Okay, sir.
What is exercise price?
So that's a price that the employees can exercise, which is lower than the market price.
Excellent. Correct. So this is technically the price which the employee has to pay to the company to get the share. So normally this will be lesser than market price of the share. So fair value of an option is equal to fair value of the share's market price, fair value of the share minus exercise price. For example, see, I am giving you one share at 120 rupees whose fair value is 150. What is the fair value of share or market price of share? 150. What is the exercise price? 120. So the difference between 150 120 is there, no? That 30 rupees, that is what we call the fair value of option. You understand it? So shall we go to 3B? Sandeep, read 3B, ma.
Noor Limited has its share capital divided into equity shares of rupees 10 each. On 1/1/2021, it has granted 4,000 employee stock options at rupees 40 per share when the market price was rupees 60 per share.
Wait, can you tell me what is the grant date?
1st January 2021.
1st January 2021. What is the journal entry we pass on the grant date?
No entry.
No journal entry on grant date. Okay, correct. Then what is the exercise price?
40.
What is the market price?
60.
What is the fair value of the share?
20 rupees.
20 rupees. Fair value of option is 20 rupees, correct?
Yes, sir.
What is this 20 rupees? Can I say this 20 rupees is the employee compensation? This is the salary I am paying.
Yeah, yes, sir.
Correct?
Yeah.
So imagine Sandeep is employee in my company. Sandeep gave 40 rupees to my company. I gave one share, which is 60 rupees. Now, my friend Dharini, who's sitting next to me, is asking, Pavan, have you lost your brain? I thought you are a good businessman. What the hell you are doing? To your employee, you are taking 40 rupees and you are giving share of 60 rupees, dude. You are mad. Then I told, my dear friend, this 20 rupees, I am giving it as a salary because he's working very hard. So this 20 rupees will go to P&L as a salary, employee compensation expense we write, correct? Now fair value of the option is 20 rupees. Dear ICA, even if you do not give this line, we know what is fair value of option. Read ma, next, continue.
The options were to be exercised between 15th March 2021 and 31st March 2021.
Another important thing I told you in the class, if you remember, always try to understand whether the whole story is getting completed in the same year or it is spreading into different accounting years. If it is spreading into different accounting years, you need to prepare that table. Okay, how to ascertain, how to estimate the cost, and how to apportion the cost between various years. But if the whole story is getting closed within one accounting year, then simply you need to just pass the journal entries for issue of shares and then transfer that employee compensation to P&L. That's all. So it will be very simple. Now look here, it is starting in 1/1/2021 and it is ending in 31st March 2021. That means within 3 months everything is over. That means there are no vesting conditions also. Maybe for the past performance of the employee you are giving it. So I called Sandeep and I said, hey Sandeep, you have been working so hard in my company. I'm very happy. Take this 100 shares at 40 rupees. So I'm not asking Sandeep to satisfy any future condition. This is one way of giving it. Another way of giving it is I call Sandeep and say, hey, next 3 years, Sandeep, if you work in my company and if you do this, I will be giving you 100 shares on that day. So this is futuristic. So whenever the problem closes within 1 year, no, that is a simple problem. Maybe there are no conditions to be satisfied. You understand? So now you tell me, Sandeep, the whole story is getting closed within 1 year or no?
Yes, sir. It's closing within 1 year.
Continue, read.
The employees exercise their options for 2,500 shares only and the remaining options lapsed.
So do we need to do anything for this remaining options lapsed?
No, sir.
No, we don't need to do because we'll do accounting for 2,500 shares only. If it is spreading into 3-4 years, no, then what happens? Today, I do not know how many will be exercised after 4 years. So what we do, we will do accounting for 4,000 employee stock options. But in this particular case, the whole story ended within one accounting year. On the date of, balance sheet, I clearly know how many options are exercised actually. So my actual data is available. I don't need to estimate anything. Are you getting my point? I don't need to estimate anything. I have actual data. So I will write journal entry for 2,500 shares issue. Okay, next, continue.
The company closes its books on 31st March every year. You are required to give journal entries as would appear in the books of the company for the year ended 31st March 2021.
Typical exam problem, easy problem also. Okay, so put the heading. Put the heading in the books of Noor Limited. This Noor Limited is there, no? I have seen in so many examinations, so many RTPs. So they love this word Noor Limited. Even in ratio analysis, it is there. In FM, some other chapter, it is there. In accounts also, they used Noor Limited in some of the questions. Good. Okay, journal entries in the books of Noor Limited. Journal entries in the books of Noor Limited. Okay, another try down, first one. 31/3/2021. You can write 15/3 to 31/3 like this, or you can simply write 31/3 also. Okay, Sandeep, how many shares you are giving?
2,500.
At what rate you are giving?
40 rupees.
So 2,500 into 40, how much?
It's 1 lakh.
Write down. Bank account debit 2,500 into 40, 1 lakh. Bank account debit 2,500 into 40, debit 1 lakh. Employee compensation expense account 2,500 into 20 rupees. Correct? How much is ma?
50,000.
Okay. What is the face value of share?
10 rupees.
Equity share capital account. So can I say 2,500 into 10 rupees ma?
Yes, sir.
How much it is?
25,000.
Balance goes to?
Securities premium.
Very good. To security premium. How much? 2,500 into 50, huh?
Yes, sir. 1,25,000.
That's all. This is the journal entry. Okay, under the trade-on narration. Being shares issued to employees, against ESOP, employee stock option plan. Okay, now Sandeep, tell me, do we need to pass any other journal entry?
Yes, sir.
What is that?
Close to P&L. Employee
Profit and loss
compensation
account
expense.
debited to
Employee compensation expense.
employee compensation expense. How much?
50,000.
50,000, 50,000. Profit and loss account debit to employee compensation expense 50,000, 50,000. Being employee compensation expense transferred to P&L account. Being employee compensation expense transferred to P&L account. Being employee compensation expense transferred to P&L account. So we are successfully done with the third one, ESOP. Can we go to fourth one? So Dharani, you are there? Hello. Sandeep, read question number 4, ma.
Yes, sir.
Dharani, read question number 4.
Buyback of shares for complicated limited, an unlisted company gives the following information as on 31/3/2021.
If you remember, I told you there is no relevance of whether this is a listed company or unlisted company at CA intermediate level, because if it is a listed company, there is something called, stock exchange guidelines you need to follow. Okay, LODR, there are so many, regulatory guidelines which are not applicable to you. So whether they have given that or no, we always assume that the company is an unlisted company because we follow only Companies Act. If it is a listed company, they have to comply with both Companies Act, plus they need to comply with stock market laws also, stock market regulations. So for us, only Companies Act is relevant. Okay, so read ma.
Equity shares of ₹10 each fully paid up, amount ₹13,50,000.
Okay.
Share option outstanding account 4 lakh.
Okay.
Revenue reserve 15 lakh. Securities premium 2,50,000. Profit and loss account 1,25,000. Capital reserve 2 lakh. Unpaid dividends 1 lakh. 12% debentures secured 18,75,000. Advance from related parties long term unsecured 10 lakh. Current maturities of long-term borrowing 16,50,000. Application money received for allotment due for refund 2 lakhs. Property, plant and equipment 46,50,000. Current asset 40 lakhs.
So note this as important model. Okay, they have used so many weapons.
Okay, sir.
Not difficult, but they used some weapons. Okay. Read ma. Continue.
The company wants to buy back 25,000 equity shares of ₹10 each on 1st April 2021 at ₹15 per share.
Do you remember the maximum number of shares that can be bought back shall be calculated using 3 tests?
Yes, sir.
Test 1, test 2, test 3 are there. Okay, resource test, number test and all.
Yes, sir.
Capital test. But my dear friends, remember one thing. I told you very clearly. Again, I am telling you, if it is given in the question that the company wants to buy back 25,000 equity shares, you don't need to test, test 1, test 2, test 3. You don't need to check it. So 25,000 is given in the question. So go ahead with that.
Yes, sir.
Continue.
Buyback
so 10 rupees share, they want to buy back at 15 rupees.
15 rupees.
So basically 5 rupees is the redemption premium. So what will you do to redemption premium?
We should reverse that to
share premium account.
Share premium.
Security
Yes,
premium.
sir.
Correct?
Yes, sir.
So how much will go? 25,000 into 10 rupees will go to share capital account. 25,000 into 5 rupees will go to security premium.
1,25,000 will go to
1,25,000 go to security premium.
security premium.
Next.
Buyback of shares is duly authorized by its articles and necessary resolution has been passed by the company for this.
Okay.
The buyback of shares by the company is also within the provisions of Companies Act 2013.
Super.
The payment for buyback of shares was made by the company out of sufficient balances available shown as part of the current assets.
Excellent.
You are required to prepare the necessary journal entries towards the buyback of shares and prepare the balance sheet of the company after buyback of shares.
Very good. So this is an interesting and important question. I have one doubt. Dharani, are we, exercising this buyback from the proceeds of any new shares issue?
No, sir. We are paying that with the sufficient balance in current assets.
See, there are two aspects. Cash you have or you do not have, that is a different story.
Yes, sir.
You have cash balance and you are buying back out of cash balance. That is one situation. If you do not have cash balance, in another problem, they might have told that the company sold land and with that money they are buying back. The company sold investments. With that money they are buying back. The company sold plant and machinery. With that money they are buying back. The company sold one division. With that money they are buying back. So cash aspect has nothing to do. Now the question is, are we buying back shares out of, issue proceeds of new shares? Or if I am not issuing new shares, then it is buyback out of reserves. Am I buying back out of new proceeds or am I buying back out of reserves?
Here we are buying back with reserves.
If you are buying back out of reserves, what to do? The nominal value of the shares bought back should be transferred to CRR, capital redemption reserve. So this 25,000 is there, no? This is the number of shares bought back into what is the face value? 10 rupees. So nominal value of the capital bought back is 25,000 into 10, 2,50,000. From free reserves, you need to transfer it to capital redemption reserve. So you'll pass a journal entry. Free reserves account debited to capital redemption reserve, 2,50,000, 2,50,000. Correct?
Yes, sir.
That's all. So simple question. Okay, I'll show you to pass the journal entries and all we'll write, and then balance sheet only I'll show you how they have presented and all, because writing balance sheet will take more time. But in this question, the focus is not on the balance sheet. The focus is on the buyback. So shall we do buyback, ma?
Yes, sir.
Put the heading in the books of, what is the name of company? In the books of Complicated Limited, journal entries for buyback. In the books of Complicated Limited, journal entries for buyback. Journal entries for buyback. So you can put date, then you can put particulars, debit rupees, credit rupees. Date 1, 2, 3, 4 you can write, or if you know the actual date, you can write. So Dharani, tell me, what is the first journal entry I need to pass? Equity share buyback account debited to bank account. Correct? Huh?
Yes, sir.
How much? Tell me, ma. 25,000 into 15 rupees I'm paying. Huh?
Yes, sir.
So it will be
3,75,000.
Yeah, yes. This is first journal entry. Okay. 2. You want to write the narration also? Write down. Being buyback of 25,000 equity shares. Being buyback of 25,000 equity shares at 15 rupees per share. Being buyback of 25,000 equity shares of rupees 10 face value at 15 rupees per share. Okay. Now tell me, out of this equity share buyback account at a rate of 15 rupees we calculated, we have two components. What are they, ma?
Equity shares and premium.
Okay, so this we have debited. Now we need to reverse capital. So equity share capital account shows the credit balance. When you are reducing it, it is to be debited. So equity share capital account debit. How much? 25,000 into 10 rupees.
2,50,000.
Then revenue reserves. Sorry, what is that? Security premium, not revenue reserve.
Premium on redemption.
Premium account. Or
Then
you see, I'll tell you, 1,25,000 to equity share buyback. 3,75,000. Guys, listen carefully. Either you can do it like this, or sometimes what ICI does, they will not write security premium here. They'll write premium on buyback of equity shares, they will write. And then in the next journal entry, they will write security premium account debited to premium on buyback. In some problems, ICI does like that. In some problems, ICI does like this. What to do? The best way is writing two separate journal entries. Then what will happen, you have to write it like this. Then what you need to do, equity share capital account debit, premium on buyback of equity shares account debit, you will write 1,25,000. In the next journal entry, security premium account debit, you will do 2 premium on buyback. Here you will write 1,25,000, 1,25,000. Okay, either you can write one journal entry for this two put together, or you can write two journal entries also. So Dharani, you understand this?
Yes, sir.
Right now. So that narrations being cancellation of shares bought back, being premium transferred to or premium adjusted to security premium account. Journal entry for second, narration for second entry will be cancellation of shares bought back. You buy back shares and you cancel them. Physically, you destroy them. If physical share certificate is there, you will destroy. But nowadays, everything is dematerial, demat form. Then next journal entry is security premium to premium payable on buyback. And then you will write being premium payable on buyback adjusted against security premium account. Okay. What to do next, ma? Hello?
Yes, sir.
Everything over, or do we need to pass one more journal entry?
One more journal entry.
One more journal entry. What is that? Nominal value of the shares bought back to be transferred from revenue reserves to capital redemption reserve.
Capital. Yes, sir.
Revenue reserve account debit to capital redemption reserve account. How much?
2,50,000.
2,50,000, 2,50,000. In one of the problems, ICI, in one of ICI study material problems, they said the company sold investment, and out of the cash received on sale of investment, they have paid, they have bought back equity shares. Okay, so investment will be some 100 rupees. They sold it for 125. You have to pass 25 profit entry. You need to, when you are preparing balance sheet, you need to add this 25 rupees in the P&L. All these things student will do correct. But they will miss writing this journal entry. Even if you are buying back out of sale proceeds of some asset also, you are not issuing new equity share, then you need to pass this journal entry. That's all. The journal entries are over. You can write being the nominal value of shares bought back. Write on the narration, being the nominal value of shares bought back is transferred from revenue reserves to capital redemption reserve. Okay, you're done. So we need to look at the balance sheet, correct? Huh? Okay, now look at this. Look at this. So equity share capital, Dharani, they have given 13,50,000. In closing balance sheet, how much will be there? You tell me.
Sir, minus 3,75,000.
I'll kill you. Not 3,75,000, 2,50,000. You need to reduce from
Yes,
share
sir.
capital. 1,25,000 from security premium.
Yes, sir.
What, madam? How much should I write?
11 lakhs. 13,50,000 minus
13,50,000 minus
2,50,000.
how much it is?
11 lakhs.
11 lakhs. Okay. After that, share option outstanding account. Did we do anything to this?
No, sir.
No. So that will come as it is in reserves.
Yes, sir.
4 lakhs. Share option outstanding. How much? 4 lakhs.
4 lakhs.
I'm not following schedule 3 pro forma. Okay. You have to follow. Revenue reserves 15 lakhs. So how much will come in closing?
Minus 2,50,000 we have to.
Excellent. 2,50,000. How much will come?
12,50,000.
Next line. Capital redemption reserve. Just now you created capital redemption reserve, no?
2,50,000.
You see, this put together is actually previous year. It is revenue reserve. Now it is split between revenue reserve and CRR. That's all.
Yes,
so after
sir.
that, security premium 2,50,000 is there. How much should I write?
We should add that 1,25,000.
Add a subtractor.
Subtract 1,50,000. 2,50,000 minus 1.
You have debited security premium in the journal entry. Security premium is equity account which shows credit balance.
Yes, sir.
So when you have debited it, it reduces.
It reduces.
Yeah, security premium account. Uske baad P&L 125. Did you do anything to this?
No, sir.
Profit and loss, how much?
1,25,000.
1,25,000. Then capital reserve already 2 lakhs is there. 2 lakhs. As it is, I have taken. Unpaid dividend. Where will you show unpaid dividend, ma? I think it should be shown in the current liability because unpaid dividend you have to pay immediately. No, you will not have more than 1 year to pay. So in
Yes,
current
sir.
liability, we'll show unpaid dividend 1 lakh. Where will you show current liability? Then 12% debentures secured. Where will you show?
Long-term borrowings.
Long-term borrowings. Non-current liabilities you will show. 12% debentures 1875. 1875. Non-current liabilities debentures. Okay, presentation schedule 3 you have to take care. I am just showing you how to tally balance sheet. Okay, if you do not write in schedule 3 pro forma with all the notes, you will lose minimum 1-2 marks. Minimum. Okay.
Yes, sir.
Then advance from related parties. You have taken advance. So is it a liability or an asset?
Asset.
Advance you have taken, ma. When you take advance from some other person, it is a liability to you.
Yes, sir. We have to
Isn't
repay.
it?
Yes, sir.
That is long term. So non-current liability you will show. Non-current liability advance from related party. How much, ma? 10 lakhs, huh?
10 lakhs. Yes, sir.
Then current liability, they have shown current liability, current maturity of long-term borrowing. Put a star mark. Current liability, long-term borrowing, maturity in the next 12 months. Very, very, very important. 16,50,000. For example, you have taken a bank loan. Bank loan is repayable after 10 years. Bank loan is repayable after 10 years. But EMIs you need to pay. Not after 10 years. The repayment period is 10 years. Okay. So in that some EMIs you need to pay. In the next 12 months, whatever the amount of EMIs you have to pay, in that whatever is principal amount component that you need to show in the current liability. It could be long-term borrowing, but the current maturity should be put in current liability. Schedule 3. Then application money received for allotment due for refund. This also you should show under current liability. Okay, application money to be refunded. How much more? 2 lakhs. Okay, then property, plant and equipment is there, current assets is there. That's all. Okay, so let us add all these things. Okay, then asset side PPE. PPE how much ma? 46 lakhs 50,000. Are we doing anything here?
No, sir.
No. Then current liability, current assets. Current assets how much? 40 lakhs opening minus you have paid 3,75,000, no?
Yes, sir.
So how much it will be?
36 lakh 20.
Ah, damn, disho. Balance sheet is tallied.
Tallied.
Okay, that's all. Guys, do you understand? Hello, all of you. Simple question now. Sir, why every question when you explain looks so simple? When I do at home, I am getting a mental, sir. Why, sir? Okay. So guys, any doubts in this? So far, whatever we have discussed, do you have any doubts?